My guest today is Bryan Birsic. Bryan is the co-founder and CEO of Wunder Capital. They were the winner of the U.S. Department of Energy's 2014 Sunshot Challenge. And Wunder is a funding platform that provides accredited investors an opportunity to participate in the funding of solar projects for commercial real estate. Bryan, welcome to CREPN Radio.
Thanks so much. I'm excited to be here.
Well, I'm looking forward to talking with you. The platform you have and the focus you guys have is certainly exciting. But before we get started, if you could just take a minute and share with the listeners a little bit about your background and what led to Wunder Capital.
Yeah, absolutely. So my first job was at Bain & Company, big consultancy in New York, out of college, and they didn't have an environmental group internally, and me and another colleague started one. So my kind of environmental interests and passion go back a long way. But following that, I joined a venture capital firm and spent a lot of time understanding really how technology was being brought to the lending space. All of these alt lenders, whether it's Lending Club and Prosper on the consumer side, or On Deck Capital that our venture firm actually backed, or Cabbage on the commercial side. We saw this application of software and data techniques to lending, and I was kind of in the midst of that in New York, investing into some of those companies in the early stage as a venture capitalist. And after being a VC, I caught the operator bug, and this is now my second company since leaving venture, and we're really bringing a lot of those techniques, that software approach, that data approach to commercial lending that a lot of folks were bringing over the last decade. No one had brought it to solar. And so that's what we're doing at Wunder and how my background kind of fits in. Got
it. So is Wunder then, are you guys a fund? Is it crowdfunding, or can you?
Yeah, absolutely. So we go out with 158 solar installer partners across the country as their financing package for creditworthy businesses that are putting up solar projects. So when those folks are out, talking to commercial entities, municipalities, hospitals around the country, they're giving them some material about Wunder and asking them if they want a preliminary offer. We're bringing those folks in, gathering a lot of data, doing a lot of work to underwrite and analyze those projects. And then once we've contracted them and there's a need to fund those projects, we make them available to any accredited investor in the U.S. through 5 funds that we operate, 2 that are still live right now on our website, wundercapital.com. And any accredited investor can come in and invest in those funds. They get a payment-dependent note with a projected yield, just like Lending Club has been doing for a decade. And instead of that capital going to help someone flip their credit card debt, which is most of what you see on Lending Club, it's going to attractive business or municipality or school that we've done a lot of work to make sure that's the case, or do as much work as we can to make sure that's the case, and pair you with those loans. So that's what we do in a nutshell. And to your kind of point around this question of what we are a little different in that we have funds that, our last fund that we closed had 50 projects roughly in it. So we are giving investors a lot of diversification. But to be clear, we have found that investors both aren't that great at and not that interested in going and picking individual projects, and also really need a lot of help understanding a lot of the solar pieces. So a little bit of a wrinkle there relative to a lot of crowd finance platforms. We're giving you just instant diversification to the asset class across a kind of diversified debt portfolio instead of servicing up projects for you.
Got it. So the fund actually then is the lender for the various projects, and then the investor.
Precisely right.
Investor is investor or part of the capital for the fund.
They're actually the only capital for the fund, so they're really simple structures. To your point, they are the lenders. So basically, these entities, these funds, sell payment-dependent notes to raise capital at projected yields. They then go out and use that capital, generally within about 30 days, to go out and finance a project that pays the projected yield, or in some cases, slightly more. So these funds only have those claims against their cash flows from investors they're selling notes to. There's nobody else in the capital stack. If that loan portfolio pays out, then you hit your projected yield. It's as simple as that.
Got it. You mentioned that you guys work with the installers or the project, the people that are selling the projects. Is that your primary vehicle for attracting opportunity?
Yeah, that's precisely right. There are in more and more states around the U.S. as solar gets cheaper, great local installation and construction firms that are out talking to businesses in their area, having folks come in and call all the time. And so we're lucky in that we have more than 150 great partners in 30 states that want to offer our product to their borrowers. And I think it comes down to two things. One, because we're software enabled, we're incredibly fast. We're incredibly transparent. We're easy to work with. We don't ask for a lot of data from you because we go get it ourselves in relatively automated ways. And then the second piece is we're really focused on a market that has been underserved by the kind of big institutional capital markets for a very simple reason. And that's actually why we think we can bring a really attractive yield to our investors, some really great, as we see it, commercial credit. And we think some pretty attractive returns, particularly given these things are actually asset backed by the projects as well. The loans are. So, we think that there's a really interesting space whereby you're not using investment grade credit scores. The S&P, the Hoovers, the Moody's of the world only rate about 10% of U.S. businesses. There's some really, really great businesses in those 90% of U.S. businesses that don't get an annual credit score from the big three. And our kind of special sauce is that we can actually work with those borrowers even when folks don't have an existing credit score from the big three, because we're actually efficient enough to do that work ourselves. So we'll actually go and get the financials, get the utility histories, look at the litigious history. We're going and doing the hard work to make sure it's a good deal. And so we can actually work with our partners on a lot more projects than their typical financing partner would.
Got it. And as far as the competition for funding of solar projects, it sounds like to me like you guys have kind of uncovered kind of an opportunity based on the competition is using traditional underwriting models, and you're able to kind of cut through that and make it easier. Is that what I'm hearing?
Yeah, it's precisely right. There's actually a really robust commercial financing market in solar in two places. One, if it's investment grade credit, if a CVS wants to go get a solar deal done, they do not need my help. They have investment grade credit. They can raise up their credit rating from S&P and go out and raise capital pretty easily. The other group that is pretty well serviced is very large projects. So projects above $2 or $3 million, certainly projects in the $5 to $10 million range. Plenty of folks that are kind of traditional, bespoke project finance groups are happy to look at those projects. Because as the underwriter and as the loan servicer in total, you're going to make through the life of the loan maybe 3 or 4% of the value of that loan. And so on a $5 million project, that's $200,000 at 4%. That's fine. You can spend a very well-paid professional's time writing up reports and doing a bunch of manual labor. If you're doing a $500,000 loan, which is our average, that's only $40,000. And, frankly, $40,000 is a pretty good deal if you can get it. Did my math wrong. It's about $20,000. But at $20,000, we can actually, make some great margin because we automate a lot of this process. We automate the contracting. We automate loan servicing. We do a lot of data analysis to filter out projects we know we're not going to work on. So we can actually make money at that level. These folks that do deals at 5 to 10 million, they're using lawyers on every deal that might cost as much as we make on a deal. So yeah, that's the lay of the land.
Cool. So you've kind of interrupted, or not, that's not the right word, disrupted the marketplace there and given the smaller projects an option there. Can you describe what a typical opportunity looks like for you guys?
Absolutely. So as I mentioned, our average borrower request is right around $500,000. And to give folks a sense of scale, I actually keep on my laptop a couple different pictures of different sizes just to give people a visual image. But if people can imagine the 2, 3, 4-story suburban commercial office space you probably got your teeth cleaned at when you were growing up, those all around the U.S. are probably $200,000, $300,000, $400,000 type systems. If you think about a pretty big warehouse, they don't consume a whole lot of power per square foot. So a really big warehouse that you see up and down the major, interstates, those might be $200,000 to $500,000, maybe $700,000, $800,000 systems. You see some of the broader and more spread out multi-tenant residential space, seeing systems between $500,000 to $1 million. the big box multi-tenant retail stuff where you've got an Albertsons. We have done a bunch of Albertsons. So I use that as an example, but the big box store that has the 6 different, it has the bakery and the hardware store in it. Those are generally about $500,000. They're definitely sub-$1 million systems. So actually a lot of the stuff that you kind of see driving around this country, the things that I think people think of when they think of commercial space, most of it is in this sub-$2 million range, which is why we've had a great time going out and bringing in new partners, because a lot of the stuff in their communities is stuff that is below the threshold that these kind of custom finance folks can deal with.
Got it. Do you find geographically, are there areas that are more receptive to it, or is it just an opportunity that people are looking for, clean energy, or is there?
It is deeply geographical,
Okay.
and it's all based on the price of power.
Okay.
It's a little bit based on how sunny it is where you are, but fundamentally it's about economics. And what we see is that in the states where you have to pay more for power, or frankly where it's break even, if we go to a commercial entity and they're paying $10,000 a month for power, and our total solar package, all costs included, is $10,000 per month, why are they taking action, right? Unless they're motivated by something else. We see right around 10 to 15% cost savings, definitely at 20% cost savings. The market goes from, the 3 or 4% of the people who want to pay more to be green to the 98% of people who want to save money on their power bill. And that's when we get into markets, is when these things make economic sense. And so really the places where solar works are places where power is expensive. California, most of New England, that's where it has been for 5 years or more. Hawaii, incredibly expensive. What's exciting is in the last 5 years, solar's dropped by about 50% in cost. And that has opened up a bunch of regions that have moderately expensive power, but not wildly expensive like the areas I just mentioned. This is New York, greater DC area, North Carolina, some places in and around Illinois, definitely the Southwest. The sun helps there. So there are a bunch of places that have moderately expensive power. And what's exciting is we're actually not to the median. So where we see deals making sense, if people are listening, if you pay more than 12 cents or so, give us a call, give an installer a call. You can probably make solar work. The average commercial payer actually in this country pays about 10.5 cents. So we haven't even gotten to the median, kind of the bulk of the market. And that's what's so exciting is, as these costs continue to decrease as they have for 40 years or so, because we've got these genius kids in MIT and Caltech making these things better. We're going to see a whole bunch of states open up that today just don't see a lot of solar. And by the way, that includes where I'm sitting today and where we're headquartered, Colorado. I wish it did, but we have cheap power and solar doesn't make sense here. So we actually have never done a deal in our home state.
Wow. That's kind of interesting, just the geography, and it makes sense. I mean, I was kind of wondering if it was kind of more dependent on, the cost, which makes sense, savings for the buyer or the borrower, as opposed to just they want to be green kind of thing. I think there's a lot of that feel good kind of thing, but I think at the end of the day, it's all about the dollars and cents, kind of what I've run into.
That's right.
I wanted to ask you on the life expectancy of a solar project.
Yeah.
Can you speak a little bit to that?
Yeah, absolutely. And this is, I think one of the things that has happened and why commercial entities are now getting really excited in the way homeowners probably were more 5 years ago, driven probably more by emotion, right? Not as fiduciaries. What they're excited about is the cost savings, but what they're also excited about is the maturation of a global manufacturing industry and the kind of, warranties that you expect on any other kind of capital equipment. The kind of Six Sigma manufacturing practices you expect, frankly, the kind of inventory management, drop shipping, et cetera, kind of networks you expect. So to speak directly to that hardware, the panels, which are a significant portion of hardware costs are only about 50% of total solar cost. The rest is actually construction and then all the things you have to do to get it done, financing, customer acquisition, et cetera. So only about 50% of total cost is hardware, but hardware is what breaks down in the out years, right? So that's what I'll speak to. The panels are the biggest portion of hardware, about a third of total project cost. They come with a 25-year, 80% production guarantee if you buy from good manufacturers these days. And what that means is that in year 25, they warranty that it'll produce 80% of what it produces on day one, which is fairly extraordinary, I think, when you think about it.
Yeah, no, compared to whatever else you're using now, a furnace or whatever, I'm guessing Hey, do you have any kind of sense, is that like doubling the life expectancy of a system, or is there, I mean, in comparison to a conventional?
I mean, most of the stuff that we're replacing, they're drawing down from the grid. So, the grid comparison is, coal plants that last for 45 or 50
I got
years.
it.
But if you look to some of the places where they use electricity for heat, you might be displacing, someone might bring out a heater. And in those cases, yeah, I think the lifetime's like 10 years or so. And by the way, this is the warranty lifetime. We've seen, and there's just not that many systems that were put up 30 years ago, but they've done a lot of cycle testing, and right, they try to figure out how to age these things more than the times that's passing. But there are a lot of people that think 30 or 35 years is the right way to think about a well-built system with good hardware. Now that's just the panels. Now that is the majority of the hardware cost. There is another big cost, which is the inverter. The inverter will end up being probably about 10% of project cost, 5 to 10% of project cost, depending on the system type. The inverter has generally a 10-year warranty, but we will model a replacement of the inverter in year 11 in our project economics to be conservative. You might get to year 15 on an inverter, but you're going to have to replace an inverter between the panel warranties. So you should basically expect 2 inverters for each panel. But again, very well built, great warranties, reinsured, domiciled in the US, all of that good stuff you'd expect. And that's it. So you should be able to get 25 warranted years off of this if you go through one inverter replacement, basically.
Got it. I want to go back to the cost. You mentioned that the cost has come way down. And
Yeah.
I know the recent political climate has been to kind of stop some of the importing of the lower cost solar, or the dumping of solar. Do you see that having an effect on this marketplace?
Yeah, we wrote a blog post about this on our site, and the title, and I think this is the appropriate headline, is 2017 all over again. Because we're in 30 states, we get data from more than 150 partners on pricing. The price of solar went down about 10% last year. So from January to December of 2017, we saw about a 10% price decrease. And we'll see exactly how the implementation plays out. But folks like Goldman Sachs are pegging the total impact to project cost at about 5%. And so we're really just going back to pricing that we saw in July of 2017. And 2017 was a great year for us. We grew 8x year over year last year.
Wow.
And the commercial solar market more broadly actually outpaced residential solar in its growth for the first time in 6 or 7 years. So I'm not sure that I'm so worried about replaying 2017 and that pricing and going through that year effectively again as it relates to where the economics work and what states you can penetrate and those sort of things. It did delay the growth of solar by probably 6 months if you're aggressive, 12 months if you want to be really conservative as it relates to pricing. So in effect, what we're going to see in 2018 will be 2017. We would have seen what will now be 2019 pricing in 2018. So it hit pause on the market for 6 to 12 months. Fortunately, where we paused is a pretty good place to be. So it's not that it's nothing. It is damaging. It slows the market. But I think some of the, histrionics about, will the market be okay? It's like, guys, were you okay 6 months ago? Because if you were, that's the market we're in again. So I don't quite understand some of the more dramatic reaction, but it's not a great thing. The one thing I will say just to close, I think is, each particular policy item, we can discuss the specifics and I can have my response, but I think there's a question of how hostile is this administration to our industry? And I think we've actually had 2 very hopeful data points actually in the last couple of months. And the first was the reconciliation of the tax bill. In the Senate version, it was actually favorable to commercial solar, including the corporate tax cut, which helps our economics because we generate profits by our systems. And so the cash flow is better on them relative to other opportunities. And the House bill actually had a negative impact on solar. And our industry lobbied, talked to the groups, and the administration actually came down in reconciliation on the pro-solar side. So we ended up getting the Senate version of the bill in that portion of the language, and the administration came in directly to kind of help with that discussion. And when I talk about the tariff that just came down, the U.S. Trade Organization actually recommended a stronger tariff with a smaller carve out. They recommended 35% with a 1.5 gigawatt carve out, and we got 30% with a 2.5 gigawatt carve out, i.e. the first 2.5 gigawatts don't get tariffed. So again, the administration had the opportunity, had plenty of coverage from the U.S. Trade Organization to, be more damaging to the industry, and they actually moderated that position. So I think we've seen that despite the rhetoric, despite what we hear about China and trade, clearly there are people in this administration that understand this industry has 250,000 jobs in this country, and they're high-paid blue-collar workers, and a lot of them are in red states. And clean energy pulls crazily well with the populace. And so we're seeing that reality kind of come into the process in a way that I think is really encouraging.
Oh, good, because I was kind of reading through there, and I thought I saw some news that suggested that it wasn't as punitive as it may have been. It sounds like you can confirm that. What about tax credits? Is the marketplace dependent on tax credits?
Yeah, tax credits are a part of the economics without a doubt. So there's a federal investment tax credit awarded to the owner of the system that generally makes that first year a very positive one because you get the tax credit awarded for the entire system in year one. And, to be frank, if you're a commercial entity, it's great to talk about things that last 25 years, and it's great to talk about saving 10% in your power bill. But if you can come in and also have in year one a really positive impact to your, free cash flow because you reduce your tax rate effectively for your organization, that's a pretty good look as a finance guy. So to be honest, it's if you look at the total ROI of the project over 25 years, it's not that these things wouldn't pencil without it. They would. But it is a help in motivating particularly commercial entities who are driven, I think, more by economics than homeowners to make the leap. The only thing I'll say about that is, we have a long, and I think well-substantiated history of giving some government benefits to energy production industries. You can't find an energy production industry in this country, hydrocarbons very much included, that do not get some kind of tax credit or subsidy because we recognize particularly independent energy generated in the U.S. as a strategic asset. So the treatment of solar is not particularly different than the treatment of other energy generating assets. That said, it does play a role, particularly, as I say, in that year one.
Got it. I want to shift gears here just one second. On the loans that you guys make, do you guys keep the loans, or is there a secondary market where you sell on these, or do you keep and service the loans?
Yeah, no, we're a full service lender. Our funds are the issuer of the loans. We keep the loans in that fund vehicle, and we're servicing those loans directly ourselves. So there is a broader secondary market for solar assets when they're 100 or 200 or $300 million pools. That assuredly exists. But as a individual holder of Wunder notes, we have not created a liquid secondary market, just to be clear. We're pairing people very much in the way Lending Club kind of innovated and in some ways created this space, at the very least led it. We're pairing you with debt that we're issuing, and you're effectively on kind of the bank side, if you will, of those loans. And, in the same way that my mortgage company can't come to me and ask for early payment, where we can't go to our businesses and say, hey, you have a 10-year loan, but it's year 3. We need a lot of principals. So you are locked up, but in the same way, you're the only claim against those cash flows, and they are backed by an asset. So it's definitely people who are trying to buy and hold. It's kind of steady cash flow stream sort of approach. That's a great fit. If it's something that you want to kind of trade or somehow have kind of the quick term liquidity that a secondary market would provide, it's probably not a great fit.
Got it. One more question on the borrower side of this. I thought I read on your website there that unlike other things I've read about solar projects and stuff, you guys are able to lien only the project as opposed to the property. Is that right?
Yeah, exactly right. Exactly right. So one of the things that got us most excited about starting a crowd finance platform and a kind of vertical lender, if you will, in this space in solar, is the incredible recovery values coming off of these projects. And Solar City really kind of kicked this party off, if you will, as it relates to the awareness of this. Frankly, we were seeing some data because we were part of an NREL group earlier than that had some anonymized data that we were seeing. So, but in early 2014, Solar City published, I think, the first public data on the kind of recovery values people were seeing from solar debt portfolios. And they reported, including all costs, 81 cents on the dollar back to their investors in the case of default. Which is about as well as you can do in the ABS markets. I mean, that's like as good as grade A commercial real estate or right around there. So, when you have an asset whereby, we could absorb, which would be, wildly outside the bounds of our expectations and historical norms. But, if you have 20% default rates and your effective losses are only 4% and you can lend at 8%. So even in a 20% default environment, you're still returning capital and you're definitely preserving principal. I mean, that is just an incredible dynamic to have for an ABS security. And so we saw what was going on there. We saw the way that it was happening, which I want to be really clear about because I think it's unintuitive. A lot of folks would think, okay, you have this piece of hardware, you're going to go out and somehow try to rip it off and sell it. That is absolutely not an economically viable way to recover value. What you need to think of it as is not the hardware, but instead 25 years, in the case of the panels, of warranted generation of a saleable asset, of a cash flow stream. It is a mini business that has one asset. It generates electricity and it sells that power to the best buyer. And generally that best buyer is whomever's in that building after that person goes through bankruptcy or leaves that space for insolvency reasons. So in short, you go from having a claim against a borrower for a monthly payment to being a seller of that electricity to whomever the tenant is in that space. And through that method, because the underlying deal for the borrower was to save money, right? So if they were paying $10,000 a month for utility, you get them a deal that might be $8,500, including all financing costs. Why would the next tenant not want to save 15% on their power?
Right.
So you show up and say, hey, great news. I've got a really cheap energy generation system on your roof. Do you want to save money? They say yes if they're rational people. Businesses are particularly rational. And now you're making, dollar for dollar or a little bit less. Sometimes you have periods to set that up. You've got sales costs, right? But the fundamental economics should be the same for whomever's in that building. And so because of that, we developed a whole practice, frankly, like a hard money lending practice, where we spend as much time substantiating the value of that asset, the warranties involved, who's building it. We only approve about 30% of the installers that apply to work with us, because we want people building these systems in an incredibly high quality way. We want the best. And we're making sure the economics pencil. And so we're really setting ourselves up to be someone who's specialized in monetizing these electricity generation assets on top of specific pieces of real estate. And, frankly, we think that's worth a lot more than going through some multi-claim senior lien process in bankruptcy with 3 other real estate lenders, which is pretty messy and nasty.
No. Yeah, I can only imagine. Let me ask you, just so I understand. So do you guys then retain ownership of the project, and then so the borrower actually pays for the? And I want to make sure that I'm understanding both ways. So if I'm a property owner, I've got a strip mall, whatever, and come to you, we get a project, we get the funding through you, we're making our payments, we're making savings, we're all happy. Yeah. Is there at the end of the term, I think I saw the amortization was 25. It seemed like it was a little
20 years.
20 years.
Amortization is 20 years. Yeah.
Okay.
So, just because of the length of these assets and how long they're going to generate cash flow helps to match the amortization terms to their effective lives. Because again, it's a cash flow generating entity. And so you can create effective savings from go if you can stretch it out over the course of those years. To be clear, we are not owners of the entity until they default on their loans and we have to take ownership. So it's a lot like a mortgage.
Got it.
You own your house, but
Yep.
you're 60, 90 days late. You don't own your house anymore. So in the case of default, we would go in and own those assets. Otherwise, we simply have the only claim, the senior claim against that asset, perfect that collateral in the same way you do with a piece of real estate. And are prepared to execute against bankruptcy proceedings, which frankly are really straightforward when there's only one claim against the asset. It's a lot like auto lending or capital equipment. Right. You have a direct claim. It's honestly the first thing they often deal with in bankruptcy proceedings from what you've seen. So
got it. So with respects to, what was I going to ask you? I'll come back to it. Let's talk about the investor side of the equation here. So the opportunity for investors. Can you talk a little bit about, what is, and we already established that they have to be an accredited investor, but kind of the minimum investment, go from there.
Yeah, absolutely. Unfortunately, the 2012 Jobs Act structure that we use, that a lot of crowd finance platforms have used, the SEC restricts that vehicle to accredited investors only. That said, just so folks kind of understand what that means, it's $200,000 in the last 2 years in income if you're an individual, $300,000 if you're a family last 2 years, or $1 million in total assets outside of your home. So that can include things like 401ks and second homes. So I think there are a few more people that are accredited than maybe realize. We get a lot of people who say, "Oh, I didn't realize I was accredited," particularly folks with some retirement assets or second homes. But that said, that is the market we service. We offer them these funds, payment-dependent notes. So these fund-based payment-dependent notes, and these funds sell you the note with a projected yield. We have right now on the site 7.5% with a 5-year term and a 6% with a 10-year term. The 10-year term is fully amortizing. So that one actually the borrower pays back in full in those 10 years. Whereas the 5-year term has a 20-year amortization period. So they will have a remaining principal that they're generally going to refinance, and Wunder's well positioned to do that when they need that refinance in year 5. So the other piece is, as you say, the minimum. So we have $1,000 minimum. We have a very automated platform, hopefully really easy to use. That's mostly what we hear. So we're able to take a relatively small investment size, and I think as importantly, we're allow ourselves with that automation to have a really low investor fee, particularly for an actively managed kind of specialty fund. So we only have a 25 basis investor fee for those funds that are available on the website, which, as folks might know, comps pretty well to things like index funds, where it's neither specialty nor are they doing any active management. So our technology allows us, I think, to be pretty flexible in those ways for our investors. And I think that's all of it.
Got it. And actually, you answered my question that I forgot there. It was about the end of the loan term, if you guys do the refinancing or if there's an opportunity there. But let me ask you, though, on the opportunities for the investors. Is this something where an investor can do like a self-directed IRA into this as far as an option, or 1031K option, or?
Yeah, so we've actually partnered with, frankly, we're a technology shop and we want to keep those fees as low as we can. So we partner with a firm called Strata that is a SDIRA platform. And so investors can set up an account on Strata. We've actually been running a promotion that I think will likely continue for at least the next 30 days of covering your first year of fees with Strata. If you're setting up a Wunder account, and you set up an account with Strata very easily, we connect with them on the back end. You come through, execute your investment with Wunder, all pretty seamless stuff. So yes, we're supporting SDIRAs, and we're actually in the process of evaluating our next partner. Strata's, I think, a really wonderful solution in terms of integrating with how we think about the world. But there are a lot of folks on some of these legacy platforms, and they're playing some catch up on the tech side. But frankly, we've seen them investing a lot in the last 12 months even. So some of those folks that there were some manual steps that we couldn't quite keep our fees where they were, right, and work with them. They've really stepped up their game. So we're actually looking at the 3 largest SDIRA platforms right now to figure out which will be our second to integrate with.
Got it. What about 1031 exchange? Is there any vehicle or option for somebody rolling out of an investment property to use those funds in this, or invest with Wunder?
So unfortunately, because it is just debt, we're not purchasing, a real estate asset or a fixture to real estate. We're not going to get those kind of tax treatments that people often see with those types of investments. There is, potentially an opportunity if folks are listening and have very, very large, bite sizes. We do some kind of custom work with folks that have tax passive income appetite, frankly, to take some of the tax credits associated with our projects. There are cases in which, and the explicit example is folks who don't pay taxes. So if you look at municipal projects, school projects, hospital projects, they can't use any tax credit because they have no tax liability. So there are kind of structures that allow us to bring those folks in. They're pretty custom and they're pretty costly, to be honest. So we're talking like 7-figure minimums. So pretty substantial stuff, but we can work in that way in kind of a one-off basis if someone is really sizable. That said, our standard kind of fund-based debt product, there's just no tax kind of advantage associated, and as such, we haven't integrated those sorts of supports. The other thing we do support, though, because we work with a lot of family offices, a lot of foundations, is we support both trust and company structures, so LLC structures. So if you've got any kind of tax advantage entity that you're looking at, it's likely that we support it.
Got it. And just to kind of round things out, so how does Wunder get paid?
Yeah, so a lot like, frankly, Lending Club again, and a lot of the loan origination platforms, which is kind of the core of what we do, is going out and finding great commercial solar deals and going through a bunch of steps to make sure that they're as attractive as they can be as investments for our investors. That's the core of what we do. And frankly, we manage these funds because we need a place to put our loans and raise capital for them. But as that, or I should say, reflecting that focus, a lot of what we make is we make a loan origination fee. So as anyone who's ever got any kind of long-term debt knows, there's generally closing fees associated, the bulk of which are loan origination fees. We do charge that to the borrower. And again, this is commercially standard, so they're expecting that. And then we are the loan servicer. So on an ongoing basis, we're charged a pretty small nominal amount to the borrower each month to service their loan. So those are the two kind of core ways that we make money. We also do charge these relatively de minimis investor fees. Those are really intended more to cover our cost on the investor side, to be frank. Where we're really making the margin is on our services to the borrowers and structuring the deal and servicing the deal.
Got it. So do you guys participate at all in any of the tax credits, the opportunity to sell tax credits, et cetera? Or?
Well, that was kind of what I'm referring to, the custom structures.
Okay.
You can't, people say sell tax credits. You can't sell tax credits.
Right.
You have to be the initial money in, and you have to be the owner. And if you are, you're awarded the tax credits. And then there's actually there's a lockup associated with owning that asset. Even though you get the tax credits in year one, you have to hold it for 5 years. And generally what you do is you end up structuring a separate SPV. The person who owns that SPV is the person who's looking to get the tax credits. They sign a deal with whoever the borrower is, and we come in for the debt into the SPV. And so we still have claim against the entire asset against the flow, but you basically put this little entity in the middle such that that person can capture the tax credits as the owner of that system. And that's the kind of structure you use for a municipality, a hospital, or a school. Now, that being said, as you can tell, that's a custom one-off kind of process. And so that's why that's something we absolutely can't do for someone who has 5 or 10 or even $250,000 of interest. You really have to get pretty sizable before doing
Right.
those kind of custom deals make sense.
Got it. Well, Bryan, this has been incredibly informative.
Awesome, thank you.
Is there anything that I should have asked you that I haven't? You've kind of taken us from the types of projects, the borrowers, the investors, how you guys work. Is there something I missed?
I think no, I don't think there is. I think that the thing that we get really excited about that I think somehow gets missed in kind of the stories about solar and maybe just the myopic kind of nature and busy nature of our days in 2018, but there's a really, really big kind of decade or 2 decade long story playing out where for the first time ever, something that's on a technology cost curve, the way that Moore's law drove down the price of semiconductors, is going up against an industry that doesn't see cost decreases with any regularity. Right now we're in this time where solar is getting to the point in different places where it makes some sense and starting to see real traction in different states. You look a decade out, and unless the cost curve just wildly changes relative to its 40-year average, solar is going to be, I think, much broader, much more penetrated, and much more economically viable, which is to say something like 50% cost savings in a lot of places if you put up solar. And I don't think people are kind of ready for that. And I think it's really exciting to be on the cusp of that. The other thing about that is that we will no longer, I think, be able to offer the kind of yields that we have. This market's going to clear. It's going to get a lot more competitive. And, we think there's a big opportunity today to jump in early and make some great yield in a space that I think is more mature and has more legs on it than a lot of folks are realizing because they looked at it 5 to 10 years ago. And frankly, a lot of stuff has changed. So I think that macro narrative, that pulling back to 80,000 feet and just looking at the long game is something that is why we get excited when we wake up in the morning. I know we spend a lot of time on details, but for us, that's what it's all about.
Got it. Well, it's certainly an industry that I think anybody of of a certain age has certainly heard about it in school and understood all the benefits of it, and probably scratched their head as to why it hasn't been. But I'm certainly happy to see that it's economically viable and making sense, and something that industry can grab hold of now. So that's great. Bryan, where can the listeners go to find out more about Wunder Capital and connect or learn more?
Yeah, absolutely. We're at www.wundercapital.com. Spell it with an O, spell it with a U. It all goes to our site, so don't worry about the spelling. We're at Wunder Capital on Twitter. And I'm at Birsic on Twitter. I'm Bryan at wundercapital.com if anyone wants to reach out. And would love to hear from you if you're interested in, frankly, either borrowing to go solar or this investment opportunity.
Got it. Bryan, thanks again for taking the time to talk. I've learned a lot, and hopefully we can do it again soon.
Definitely. Thanks so much for having me.
All right. For our listeners, if you like the show, share it with someone you know. And remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.